Welcome back, everyone. Today we're doing a deep dive into Forex market structure using insights we got from, the inner circle trader,
ICT, yeah.
right, ICT. I was going through his stuff, and it really struck me how much he emphasizes self-awareness, especially for, traders just starting out.
Yeah, it's refreshing actually. So many beginners just want to jump into the most complex systems, but ICT really stresses knowing yourself as a trader first and foremost.
Absolutely. He even suggests that if you're brand new to Forex, short-term or day trading might be a good way to, get your feet wet.
It's about the feedback loop, right? Short-term trading gives you those quick wins or losses and helps you see if your analysis is on point. Sort of like testing the waters before diving into the deep end, so to speak. Plus, those early wins as you're figuring things out can be a great confidence booster.
It makes a lot of sense. You learn by doing. Now, ICT also talks about this trading pyramid, basically looking at the market using three different time frames. Could you break that down for us?
Sure. So picture a pyramid, right? Three levels. At the top, the widest part, that's your highest time frame. That's your broadest market view. This helps you establish a directional bias, like are we looking at a bullish market or a bearish market?
Gotcha. So that's setting the stage, getting a feel for the overall sentiment.
Exactly. Then we move down to the middle of the pyramid, the mid-level time frame. Here's where you refine your entries. It's like fine-tuning your strategy based on what the bigger picture is telling you.
Okay, so say your highest time frame suggests a bullish market, you'd be looking for buying opportunities on this mid-level time frame then.
Exactly. And finally, the bottom of the pyramid, that's your shortest time frame. This one is all about timing those countries, those little triggers that confirm the move you anticipated on the higher time frames.
So it's a three-step process. Establish a bias, refine your entry, then confirm with timing.
Nailed it. And the exact time frame combination, well, that depends on your trading style. Like a
Yeah.
long-term trader might analyze monthly, weekly, then daily charts. But someone who's more short-term, they might focus on the daily, the 4-hour, then the 1-hour charts.
It's amazing how this pyramid structure makes it all seem less chaotic. Now let's talk market structure. That sounds kind of abstract.
Yeah.
How does ICT define it?
Think of it as the underlying architecture of the market. It's revealed through the price movements, the rallies, the declines, even those periods where the market seems to just chop around.
So instead of getting lost in the minute-by-minute price ticks, we're looking at the bigger picture.
Precisely. And within that bigger picture, identifying support and resistance levels is absolutely key.
They're like those invisible force fields, in sci-fi movies. You can't see them, but they can really mess you up if you're not careful.
Ha, perfect analogy.
Hmm.
They are invisible but powerful. And this is where market structure analysis and market profiling, they work together.
Okay, now you've got me interested. Break that down for me.
So by observing how price behaves around those support and resistance zones, we can kind of get a sense of the market's mood. Is it trending up? Is it reversing? Or is it just stuck in a range? And that's what market profiling helps us figure out.
So it's about understanding the market's intention, not just like reacting to every little price fluctuation.
Right. Exactly. It's about anticipating where the market might be headed based on these clues. And the beauty of this approach is it helps you identify those high probability trading opportunities. Remember the pyramid we talked about? Yeah, this is where all those different time frames come together to paint that complete picture.
Right. We're not just looking at one time frame in isolation. It's more about how they all connect to each other.
Exactly. For example, let's say on a monthly chart, your highest time frame, you see a break below a recent swing low. That shift in market structure, well, that suggests a potential downtrend, right?
Okay, so we're seeing a potential change in momentum on that larger time frame. Then what?
Then you zoom in, maybe go to the weekly chart, then the daily chart. You're looking for that precise entry point for a short trade, basically capitalizing on that bearish momentum you identified on the higher time frame.
Like those Russian nesting dolls. Each layer reveals something important about the whole picture. But markets, well, they're not always so crystal clear, are they? There's that gray area between entry and exit points where price action, it can feel kind of unpredictable. So how do you navigate that uncertainty?
You're right. Trading is all about navigating uncertainty, and ICT talks about nesting market structures. And this concept is really helpful when it comes to finding opportunities, even within those seemingly chaotic periods.
Okay, more nesting. So how do these nested structures, how do they actually play out in the market?
Okay, so think of it this way. You have your larger market structure. Let's say it's a long-term uptrend. But within that uptrend, there are going to be smaller swings, consolidations, even counter-trend moves. Those are the nested structures.
So even within a bullish trend, you might see these like little bearish pockets where the price pulls back before continuing higher.
Exactly. And those pullbacks, those nested structures, they are often where you'll find those lower risk entries for trades that align with your higher time frame
It's
bias.
like panning for gold.
Yeah.
You got to sift through a lot of dirt to find those nuggets, but knowing where to look makes all the difference, right?
Love that analogy. And just like a skilled prospector knows the signs of a rich vein, a skilled trader learns to identify those subtle clues within those nested structures.
So we're not just looking at whether our market's going up or down, but how it's moving within those larger trends, those nested swings and pullbacks.
Exactly. And one of the things ICT really stresses is paying attention to those short-term price swings, even when you're primarily focused on that larger market structure.
Can you give us an example of how we might use those short-term swings in our analysis?
Sure, let's say you're looking at a stock that's, in a strong uptrend. Instead of just chasing the price higher, you might wait for a pullback, a nested structure to form. And by analyzing the depth and momentum of that pullback, you can get a sense of where the buyers might step back in.
So we're essentially using those smaller swings as measuring sticks, trying to anticipate where the price might go next.
Precisely. And those key support and resistance levels we talked about, yeah, they become even more important here. They act like magnets for price, even in those smaller time frames.
This is making a lot of sense.
Yeah,
So even when we're focused on those short-term moves, we're always keeping the bigger picture in mind, using those higher time frames and market structure as our guide.
absolutely. It's all about understanding the context of each move, seeing how it fits into the larger story the market is telling.
But even with this framework, there are no guarantees in trading, right? The market is always going to have that element of unpredictability, that gray area we talked about earlier.
You're absolutely right. Market structure analysis, it's a powerful tool, but it's not a crystal ball, right?
Yeah.
It helps us make more informed decisions, but it doesn't eliminate risk entirely. And that's something that every trader, no matter how experienced they are, has to accept. The market, it will always keep us on our toes.
I think that's where a lot of new traders get tripped up. They come in looking for those hard and fast rules, those guarantees that every trade will be a winner.
Yeah, it's a natural desire, but it can also be a dangerous one. ICT, he emphasizes embracing the gray, accepting that uncertainty, and, being comfortable making decisions even when we don't have all the answers.
So it's as much about managing our psychology as it is about understanding the technical aspects of the market.
Absolutely, and that's a whole other deep dive we could explore sometime. But for now, let's focus on putting all these market structure concepts into practice.
Perfect. Let's imagine you're a swing trader. Can you walk us through a hypothetical trade setup using this three-time frame approach, incorporating those nested structures, the support and resistance, all that good stuff?
Okay, so as a swing trader, I might use the daily chart as my highest time frame. I'd be looking for signs of a potential bullish market structure. Maybe the price bouncing off a key support level, breaking above a previous swing high, forming a higher low, things like that.
Okay, so we're seeing a potential shift towards a bullish market on that daily chart. So do we just jump in and buy right away?
Not so fast. Remember, we're looking for confirmation on those lower time frames. So I'd switch to my mid-level time frame, maybe the 4-hour chart, to pinpoint a more precise entry. I'd be looking for a pullback, a nested structure within that larger uptrend.
So we're essentially waiting for the market to take a breather before it continues higher, maybe a chance to buy at a better price.
Exactly. Maybe the price pulls back to a key Fibonacci retracement level, which often acts as support.
Now, for those who might not be familiar, what exactly is a Fibonacci retracement level?
Good point. So these levels are derived from the Fibonacci sequence, which is a series of numbers where each number is the sum of the two preceding ones, like 1, 1, 2, 3, 5, 8, and so on. Traders use these ratios like 38.2%, 50%, 61.8% to identify potential support and resistance levels. They can often indicate where the price might reverse or, at least stall.
Okay, so we have our bullish daily chart. We're seeing a pullback on the 4-hour chart towards this Fibonacci level.
Yeah.
What's the final piece of the puzzle?
Confirmation. This is where our shortest time frame comes in, maybe the 1-hour chart. We'd want to see the price break above a short-term resistance level within that 4-hour pullback, confirming that that the buyers are back in control.
So it's like we're lining up all of our ducks in a row. Bullish daily chart, pullback to support on the 4-hour, then a break of resistance on the 1-hour. That's when we pull the trigger.
Almost. ICT is big on trading within what he calls kill zones for optimal entries.
Kill zones. That sounds a little intimidating.
Haha, yeah, it's not as scary as it sounds. Kill zones, they just refer to high volume trading periods like the London Open, the New York Open, the London Close. These are times when liquidity is high and the price moves tend to be more significant.
So we want to time our entries to coincide with these periods of increased activity.
Exactly. The London Open, for instance, it tends to be a high volume period because it's when European markets are opening and it overlaps with Asian markets that are still active. That overlap creates this surge in trading activity, which makes it, a really good time to enter trades. By aligning our entries with these high volume periods, we increase the likelihood of our trades moving in our favor and quickly.
Makes sense. So
Yeah.
we've identified our bullish setup across our 3 time frames. We're patiently waiting for that pullback to a key support level, and then we're aiming to enter during a kill zone for optimal timing. This is all making a lot of sense, but even with all of this analysis, there are no guarantees in trading, are there?
Nope, you're right. You could do everything right and still have a trade go against you. It's just the nature of the beast.
Which brings us back to risk management, right? No matter how confident we are in a setup, we always have to be prepared for the unexpected.
100%. ICT is a huge advocate for managing risk diligently.
As he should be.
Yeah.
Like that old saying, it's not about how much you make, it's about how much you keep.
Exactly. You can't win if you're out of the game, right? And you
Yeah.
can't win if you're constantly chasing those big wins and taking on unnecessary risk. It's about consistency, discipline. Really, it aligns perfectly with ICT's overall philosophy. He always talks about finding a strategy that works for you, sticking to your plan, and managing your risk. These are the pillars of long-term success in trading.
Well said. And speaking of finding a strategy that works, ICT also talks about being a dynamic trader, someone who can adapt to changing market conditions. But he also emphasizes the importance of, identifying your trading style and sticking to it. That seems a bit contradictory, don't you think?
Yeah.
How do we find that balance between consistency and flexibility?
It really is. It's like we want to master a specific style, like become a swing trading specialist,
Yeah.
but then the market changes on you and you got to adapt.
It's finding that balance
Mhm.
between specialization and adaptability. Think of it like a good chef. They have their signature dishes, their area of expertise, right? But they're also always trying new ingredients, maybe tweaking a recipe here and there
Yeah.
or responding to what their diners, what they enjoy.
Ooh, I like that analogy. So we're not just robots blindly following a system. Exactly. We develop a strong foundation in a particular style, we learn the ins and outs, but we also stay flexible, willing to adjust as needed.
So it's okay to tweak our strategies, experiment a bit, as long as we're staying true to those core principles of market structure, risk management, self-awareness. Speaking of self-awareness, even when you have a solid grasp of the technical stuff, those emotions, fear, greed, they can really mess you up.
Oh, tell me about it. That's where discipline comes in, having a well-defined trading plan and sticking to it. It helps keep those emotions in check. Think of it like having a roadmap. You know where you're going, you know how to get there, you're less likely to get sidetracked.
Makes sense. Taking those emotions out of the equation, relying on your analysis, your plan, not your gut feeling in the heat of the moment.
Exactly. And journaling can be a really helpful tool for that. Not just for, keeping track of your trades, but also your mindset at the time. You start to see those patterns in your behavior, like, oh, I tend to get impulsive when.
It's like holding up a mirror to your trading self,
Yeah.
seeing those blind spots.
Exactly. And not just weaknesses, but strengths too. Maybe you realize, hey, I'm good at staying calm under pressure.
Mhm.
That can be a huge advantage in trading.
Confidence is key,
Hmm.
especially in this game. Makes it easier to trust your analysis when you have that belief in yourself.
Absolutely. And that confidence comes from experience,
Mhm.
putting in the work, making mistakes even. It's all part of the learning process.
So really, mastering Forex, it's a journey, not a destination.
Couldn't have said it better myself. It's about embracing that continuous learning process, always asking questions, refining your skills, and never underestimating the power of observation and, a little bit of intuition along the way.
Beautifully said. Well, this has been a fantastic deep dive into Forex market structure. We covered a ton of ground today. Thanks for breaking it all down for us.
My pleasure. We talked about finding your trading style, those all-important support and resistance levels, making sense of price action, dealing with uncertainty, and of course the mental game. It's a lot to take in.
It is. But to our listeners, remember, study those charts, analyze that market structure, manage your risk, and never be afraid to adapt your approach as you learn and grow as a trader.
Because at the end of the day, it's not about predicting every market move perfectly. It's about understanding the forces at play and using that knowledge to make smart, disciplined trading decisions.
And who knows? Maybe you'll even find your own unique trading rhythm. Until next time, everyone, happy trading.